is Drew Crescenzo. I'm on the board of FEI. I've been on the board for over 5 years. I'd like to welcome you today. I'd like to introduce some people. Firstly, our president, Benji Horowitz. Thank you. And also we have 2 other board members, Manny Velez and Andrea Rieger. Good morning. I'd also like to welcome some sponsors that are on the call today. We have Christine Jurula from Bank United. Christine, thank you. And we have our speaker, Allan Cohen. Allan is also a sponsor. Before we get into me introducing Allan, I'd just like to go through some administrative things today. As Manny mentioned, we encourage, because we have so many people on the call, it'll be very difficult and time consuming to go around. So I suggest everyone, first of all, everyone should mute their speaker. And if you decide to speak, you could unmute, okay? I encourage everyone to use the chat room to identify who you are and if you want to reach out to any other people. Kelly will be providing a attendee list to all people that have signed up and are attending today. If you're interested in getting CPE credits, please participate in the polling questions. That'll be necessary in order to earn the 1 CPE credit. Allan, if you have a presentation deck that you want to distribute around, we could do that. Thank you. Any questions for Allan can be added to the chat. If there's any questions on the administrative side, please let me know. Okay, great. Let me introduce Allan, and it's really really honored to do this. Allan was worked for a company I was at. He did a great job for us. And about 3 years ago, he became a sponsor for FEI. And so I'm really pleased to be able to introduce him. Allan is the managing partner of Nixon Peabody, Long Island, the Long Island office. Nixon is in a firm with offices around principal cities in the United States. He represents a variety of companies, from large public companies engaging in M&A to middle-sized, closely held and family-owned businesses. Allan has successfully closed over 200 M&A transactions across a wide range of industries, including healthcare, medical device, life science, consumer products, and insurance. He also has represented technology startups and worked with VC firms and equity financing in private equity financings. Without further ado, I'd like to turn this over to Allan. And again, thank you, Allan.
You're very welcome, Drew. Thank you. And thank you for the kind words. And I'm pleased to be with everybody this morning as morning becomes afternoon. You know, it's interesting when they first asked me the topic that I would like to speak about this morning. It was a couple months ago, and the answer was M&A in the wake of COVID. And in, I guess, retrospect, looking at the way things are right now, it might have been a fit of wishful thinking, because we're certainly not in the wake of COVID, but rather in the midst of it. And that does change some of the thinking and what I'd be prepared to say this morning. So I think I'd just like launch into it. Kelly, maybe you could throw up the first polling question, because that kind of sets the stage here. Why don't you take a few seconds to read and respond to that? Okay, that's okay. It's interesting. Everybody's responded pretty quickly, and I thank you. A lot of folks are not working on any transactions right now, and others are working on transactions, but the pandemic has created issues. And I guess that not working on a transaction is the biggest issue of them all. What we've seen here is kind of interesting. The firm, the corporate group, the M&A group has been doing quite well. We're very busy, and the level of activity has been maintained, surprisingly so. A lot of it is sort of the dual forces that are in conflict with one another. One, you have COVID. Some businesses are doing poorly. Their earnings are down. Buyers are hesitant to make some of the acquisitions they might have been interested in making. But I'd be remiss if I didn't also mention that it appears that we're going to have a new president. And although the Senate is up in the air, we're not going to know until after the first of the year, maybe well after the first of the year, whether or not it's going to be a Republican or democratically controlled Senate. Part of Biden's tax plan is, as many of you know, is to potentially increase capital gains rates on income above a certain level. I've heard $1 million a year. So that's motivating a bunch of sellers to quickly engage in transactions in order to get them done before the end of this year. To the extent that they can take advantage of better tax rates, or at least not take the risk of higher tax rates in 221 and beyond, they could perhaps save themselves a good deal of money. Now, it remains to be seen whether or not there will be a change. That's a pretty heavy lift to increase capital gains rates, and it probably will not happen overnight. But the fact that it is a risk has created a bunch of year-end deals for my firm in the M&A space, which is welcome. The other end is just M&A generally and what it would be like, but for the tax or potential tax changes given COVID. And what we're seeing is this tale of two cities here. We're seeing a bunch of companies that are really doing quite well in this environment, are projected to do quite well, notwithstanding COVID, or in an economy that has this happen to it from time to time in the future. And you can say God forbid, but people get hurt enough that their memories live for a long time. And companies in the food space, companies that are doing active in e-commerce, continue to be very hot topics. And you see a migration of money, especially private equity money, into industries that hold up quite well in the face of a pandemic. And then, of course, you have the other extreme where a bunch of companies are suffering. A bunch of companies are concerned because they might have classified themselves as necessary businesses, and they did it with white knuckles. And they're concerned that if there is another shutdown, that they may not be considered essential and may be forced to shut down. So they might have, in a sense, dodged the bullet the first go around, but they may not be so lucky this winter if by some chance the economy is, or let's view ourselves locally, if Long Island businesses are shut down again. So generally speaking, the state of the market is fragile. There are some big ups, tax driven, and also driven by businesses that do well in against the background of a pandemic, and then there are others that are really suffering. And as to those sellers, I put them into two categories: ones that are just going to wait this out, wait for their businesses to revive, and those sellers that never want to go through this again. And even though they may not get the values that they were going to get a year ago, they just don't want to own businesses anymore. And they are taking advantage of the opportunity, even to reduce purchase prices to sell. So that's what we're seeing. By the way, if folks have questions, I'll keep an eye on the chat room. And I'm happy to answer answer questions as they come out of the topics I'm discussing. And then I will leave some time at the end to deal with questions either that are chatted to me or that people want to unmute themselves and ask me directly. Kelly, why don't we throw the next slide on? Okay, the question is, has your company or companies whom you work utilized loan programs? And not surprisingly, a strong majority have utilized the PPP program, as have, I'd say, most of my clients. So that's not a surprise at all. Some have utilized PPP and Main Street, and some neither, either because they didn't feel that they qualified or didn't feel like they needed the money and didn't take it. So look, the PPP program has raised a whole bunch of issues in business transactions, mainly because it's a whole new world. It was pushed out with some haste. There weren't a lot of rules and regulations, maybe some facts, but even the facts raised questions that had to be addressed in subsequent facts. So it did create sort of an air of uncertainty. So the thing with the PPP programs, of course, is you're banking on forgiveness, and there's a great deal of uncertainty whether or not these loans will be forgiven or not, although people are hopeful that it will. Some companies had difficulty spending the money, frankly, and they have other issues. I don't know whether you're working with companies that have had an opportunity to submit requests, applications for forgiveness. Up until at least recently, I understood that Chase, and maybe even to this day, were waiting for further guidance and had not yet opened up the portal to take forgiveness applications. Now, if you're a seller or buyer in an M&A transaction, let me think about this. The seller's counting on forgiveness. The buyer, who could perhaps buy assets and not take the loan, still would have successor liability if for some reason that loan was not forgiven and couldn't be repaid. So it did create a whole host of issues. Now, a couple of weeks ago, the SBA came out with some very helpful guidance. They said, if you're engaging in a transaction, you want to sell, and you do have a PPP loan that's not yet been forgiven, you can still go forward without the SBA's consent. You can always get consent, but without the SBA's consent, if you do two things. One, you escrow the amount of money equal to the loan that may have to get repaid with the bank, presumably the bank that you utilized, and you get the bank's consent, which the bank is, almost certainly going to give. One, because they like happy customers, and right, Christine's smiling, and also because if you've got an escrow established, then you really don't have much risk with regard to non-payment if for some reason the loan is not forgiven. Up until that point, there were buyers that were insisting that sellers repay the loan, which is absurd, even if the loan could be forgiven, because they just didn't want to deal with it. And if you're paying enough in a purchase price, perhaps, you can negotiate to have the seller repay the loan, and it's almost as if it's a likely or at least a potential reduction in the purchase price, or maybe that was just worked out in the business terms. So fortunately, that those new SBA regs are saving. But what I've had to endure, and my clients have had to endure, because the questions come to them, they're really financial questions, not legal questions, is sort of an onslaught of due diligence. And although I work at a very large law firm, we don't view ourselves as big law in approach. I know that some of you have worked with this firm in the past, but there are some big law firms that were just inundating with potential sellers of businesses with documentary financial requests for spreadsheets, use of proceeds broken down on a weekly basis. Now, if you're a seller, think about this. You're selling your business. Likely very few people within your organization even know that you're doing it. So you're thinly staffed, you're negotiating a purchase agreement, you're responding to due diligence requests, you're preparing disclosure schedules. And by the way, like you're running a business, right, in your spare time. So the extraordinarily detailed demands required by buyers and their counsel with regard to PPP loans was really inundating, and we had to fight back quite a bit on that. And then before these escrows were established with the banks, at a minimum, buyers were demanding that money get escrowed in case loans weren't forgiven. So again, if you're a seller, and especially with mid-market sellers, a lot of us deal with them. They're thinking about the money they're getting at the closing, right? You own your own business, or closely held company, a family-owned company, and you're trying to figure out whether this is the right time. And you go into your wealth manager and you say, "This is what I'm getting paid at the closing." You're probably telling them that money in escrow, I'll probably never see that. It's my job to make sure you get it, but you're probably thinking you'll never get that, no less get earn-out money. And then you see the money being paid at closing slowly decline. Maybe there's been a retrade on the purchase price. Maybe there are other escrows that are routinely established. Now you have another escrow with potentially millions of dollars, and you see the amount that you're getting at closing get smaller and smaller and smaller. And even though there's an expectation that you'll get all that money back at some point, there are a lot of sellers just looked at the top line, not the bottom line, but the money that they were getting at closing, and it was really off-putting, and walked away from transactions just for that reason. So buyers were able to protect themselves, and they did, but sometimes at the risk of losing the deal, which is unfortunate. Kelly, why don't you throw up the next slide?
So Alan, we did have one question.
Yes.
This was from Manny. Are you finding that previously financially healthy companies were able to flex and remain poised for acquisitions, and have found other weaker companies more easily purchased in a type of a discounted market now, especially with related to the upcoming tax changes? That was a question from Manny.
Yeah, the answer is some. I mean, it's not common because a seller typically has a price in their head, and it's very difficult even in a weakened position to accept something less than what they think they need in order to sell out, retire, and maintain the lifestyle to which they've grown accustomed. So it hasn't happened a lot, but I have had some cases, as I mentioned before, where there were sellers that really just were fed up, and they could wait a couple years, see if their company rebounds, and sell for a higher price, but they're making the decision that they'd still rather sell because they just don't want to go through this again. They put enough money aside, they're financially secure, and sort of enough's enough. So I don't see buyers wearing on their sleeve, hey, we're in good shape and you're weak, and we'd like to buy you. It's not a good look, but I'm sure they're thinking that, and they're being opportunistic. And look, there are also some companies that are failing, which are creating opportunities for buyers, because at some point the sellers just lose control of their ability to maintain a business. So Mandy, thank you for the question. So the question now is, has the pandemic, including loans, impacted due diligence? And it's interesting that your experience is a little bit different than mine, because I guess, not a majority, but most people have said that there was no impact. Combined, there still is a majority of you who have seen that due diligence increased, if nothing else, to judge compliance with the PPP program, but also a deeper financial dive, or a deeper financial dive was done. And I guess, one of the problems with the polls is you can only pick one. So some of these, maybe the answer is both. So yeah, I mean, look, if you're doing a private equity deal, and seemingly the private, I'll say private equity folks on this line, so I'll be somewhat cynical, but you're looking to justify your MBA, and you view everything as somewhat formulaic, right? Your EBITDA has gone down because of this, and then you just apply a multiplier, and you should be paying less because that's how the math works. And a lot of really great companies have been ruined by private equity for just that sort of approach. But then you're taking a deeper dive, because the last thing that you want to see is some financial issue exacerbated by an already thinly priced deal, because perhaps EBITDA's eroded on account of COVID. And it's one thing to be dealing with one ball up in the air, but what happens if you have multiple balls, financial issues up in the air? And I will tell you that any buyers, whether it be private equity or strategic buyers, I mean, they are a risk averse lot. There aren't a lot of cowboys out there. They don't usually remain cowboys because they make mistakes. Companies avoid the targets with blemishes. And if you are have a PPP loan, if you're COVID infected, obviously the two go somewhat hand in hand, then it's going to merit a little deeper dive to ensure that there aren't other financial issues that potentially depress value. So I, like others on this line, have witnessed a deeper dive into the financials, not just PPP compliance, but also an especially hard look because the risks of overstating EBITDA or revenue, depending whatever your valuation model requires, is just a lot greater than it was before. Good. So Kelly,
Allan, I have a question, Allan.
please, true. Yep.
Are you seeing a different level of due diligence that you've never seen before, outside of the PPP issue and maybe EBITDA areas?
No, I'm really not. I mean, the increase in the amount of due diligence because of the PPP loans is, to me, almost a little bit bizarre, because there are ways to secure that without doing due diligence. I mean, as long as you have the money to pay the debt if it's not forgiven, I mean, that should be the end of it. So I don't really get that, other than there's some lawyers that just get paid by the word. And so representations and warranties and purchase agreements, I mean, go on pages on PPP compliance, and then they ask for an indemnity. So like, who cares if there's a breach of representation warranty? You're indemnifying the buyer anyway if the buyer suffers some loss. So you just killed a couple extra trees for absolutely no reason. And then from the sell side perspective, I then have to read those words. So, and even if you don't put it in the agreement, I mean, it's all compliance with law, which is in every contract. So the redundancy is just a little bit silly. Of course, the financial deep dive is something that largely goes outside of my my view. I am a little bit more careful about financial statements reps, absence of liabilities reps. I mean, there is some increase in some employee issues because you could lose people. I do think that there is some increased focus perhaps on the employee sort of labor front.
Thank you.
You're welcome. Any more questions to this point? Okay, onward. Kelly,
Hey, one more question
sure.
from Alan. Are you finding any changes, higher scrutiny of projections models in relation to synergies and post-transaction value, add opportunities due to the headwinds of COVID impacting the ability to achieve these synergies? So this seems to be a COVID type issue. We could do the question 4 first and clear that, and then maybe you can address that question from Alan.
I'm sorry, Drew, I missed what you said just last.
The polling question is up. If you want
Okay.
everyone to answer the polling question, then you can address the question from Alan, which really relates to the question from Mark Brown, which really relates to the COVID impact on transactions.
Yeah, I see a couple questions have popped up, so I'll let people vote, and then I'll address Mark's and Kathleen. Thank you for your question too. Wow. Okay. Interesting. The experience in the poll far different than what I have been facing. So that creates a good opportunity for discussion. But let me address the questions first. Mark, I think that in terms of higher scrutiny projections and models, looking into the sort of the post-transaction world and how that might impact value or bring merit to the deal. I haven't really seen that as much as I think that buyers are, if they're able to be bigger, prefer to be bigger. I mean, you could be geographically or vertically more diverse. So I think that, I mean, I haven't seen the projections or the models change per se, but I'm certain the buyers are thinking that being in additional territories, for example, or offering additional products, or just being larger, and depending upon how much debt you might incur to engage in the transaction, more financially stable is certainly a benefit. I do think, as a general matter, the smaller companies are suffering more than the big companies. I don't know whether it's just sheer size. I don't know if it's just the degree of financial management. And look, I mean, I could even personalize this. I mean, I'm fortunate to work at a firm that's very large and extraordinarily well managed. We've dealt with our costs, and we came into COVID being sort of a lean, mean machine. And that's one of the reasons why we've been able to manage it quite well. I will tell you that, I've heard stories about, some other smaller law firms that were not as carefully managed. They might not have the infrastructure to do it. And they've had a more difficult time during this period. So, I mean, I do think, generally speaking, the sort of bigger is better. So I do think that whether it's baked into the projections and the modeling, or whether it's just sort of a general sense that bigger is better in a time of uncertainty, as long as you're not incurring a lot of debt to get to be bigger, which just creates other issues, I think is something that's on buyers' minds. And then from Kathleen, and I'll read the question, give Drew a break. Have you seen startup valuations being subjected to a COVID discount, even if their industry is relatively pandemic proof? If so, what is the rationale behind the discount? I have not seen that at all. I think that companies that are relatively pandemic proof are arguably attracting greater multiples and greater, higher valuations, maybe even the pandemic proof premium, like another PPP for us, because buyers, especially private equity buyers or strategics, like looking around at what is sometimes slim pickings already. If they can find a business that's doing well in this environment, and there are other competitive bidders for it, I mean, it's going to bid up. It's not going to bid down. So I don't know if the question was asked because Kathleen, you had seen it, but I've seen actually the opposite. I have some clients in industries that are relatively pandemic proof, selling. I'm working on deals right now at, to me, staggering premiums. I'm almost a little bit shocked at what folks are getting for their businesses.
Alan, do you see that if there's a risk, there's a push for buyers to do earnout in their agreements? Do you see
Yeah,
more earnouts?
absolutely. So as I said, I thought the answer to the last polling question was kind of interesting. I think half the people said there was no impact on deal terms. We've spoken a lot about price, right? The ultimate deal term. The rest of the stuff, lawyers and accountants or financial professionals perhaps are maybe more interested than the business owner. But I am seeing just a tremendous influx of earnout proposals in order to bridge the gap. And the rationale is pretty simple, which is, my earnings are not good. You do the trailing 12 months, it includes, 9 months of COVID. It's not what it used to be, but I project out, a return to where I was. And buyers are just not willing to take the risk. I mean, the whole thing is pretty unnerving. I mean, I was doing a deal which didn't go through up until a couple months ago, and it was a business in Borough Park. And as some of you might know, Borough Park has been, one of the areas that was earlier hit with a, second or third wave, a new wave of COVID cases, and they had an earnout, and the seller was concerned they wouldn't be able to make the earnout. But if the buyer is at a discount from where the business would otherwise trade, the conversation that folks always have, and we have a couple people who I know work on deals like this and have these conversations, is, well, the way we get from the buyer's price to the seller's price to a deal is we add an earnout. The problem with the earnout, of course, is we just don't know how long this is going to last. And an earnout that starts in 2021 may not get the seller anywhere because, I think, look, a lot of us were expecting a down economy anyway, right? It's been the longest expansion in history. So M&A lawyers like me were waiting for the shoe to drop before COVID. And then when it dropped with a real thud. So I think there's more than one thing going on here. So anyway, so earnouts are popping up now. Earnouts are, the hardest term in any contract. And again, I have a couple deals now. They both have earnouts in them. The issue is that the buyers just plunk down a huge amount of cash or whatever the cash is, maybe huge to them, hopefully huge to the seller for the business, and they think that entitles them to run it the way that they want to. They own it. And they should run it. You have the seller who's negotiated for an earnout. Maybe you've agreed to the broad constructs of it. I'll hit EBITDA of this or revenue of that over a multi-year period. And they're like, well, I have the buyer running my business now. Maybe they won't do a good job. So the negotiation is always between the buyer, who's drafting provisions into the purchase agreements that say, you acknowledge, seller, that I own your business. I can do whatever I want. You have no say. They don't say it quite like that, but it feels like that sometimes. And sellers who are saying, well, I want you to keep separate books and records. I don't want you to allocate overhead to my business. I don't want you to do anything with the intent, or sometimes it goes even or with the expectation of making it more difficult for me to earn my earnout. Or maybe, I have to continue to run the business, or you have to run it the way that I was running it before. I mean, fair, right? I mean, when the seller comes up with the numbers, it's always numbers based upon how they were running it and with them running it, but the buyer doesn't really have that obligation. So look, earnouts are they're very interesting, and we like to be challenged as lawyers, but you could also say the bane of our existence. They're just very difficult provisions because neither side is going to be happy with the outcome of the negotiation. Another big issue that's coming up a lot, and look, a lot of companies that you work with oftentimes have their financial people looking at contracts, sometimes even doing some amateur lawyering. So you may be looking at things like this, and it may come up is force majeure clauses have become heavily scrutinized over the course of the last 8 months. What was happening initially was everybody was looking at their contracts saying, well, it's COVID. It was something unexpected. Nobody could have anticipated this. It must let me out of my obligations, right? Or maybe there was even a force majeure clause that said an act of God excused performance. And courts have ruled that unless you are very specific, you're talking about pandemics or closures, that the routine force majeure clause that we've come to know is not letting the party off the hook for the obligations it needs to perform. So I had employment agreements, very common. So we do a lot of executive comp. So in every M&A deal, right? They're employment agreements, virtually everyone. And you had furloughed executives with employment agreements. They weren't working, and they're entitled to their compensation, even though they're not working. Because it rarely says in an employment agreement, I'm not sure I've ever seen it, is that the employer's obligation to pay the employee is subject to some force majeure clause that if we're shut down and you're not performing services, we don't pay you. So there were a lot of uncomfortable conversations between companies and executives with employment agreements because they did have an entitlement to be paid throughout. And that was the case with a lot of contracts. Now people have gotten wiser, and MAC clauses, right? Material adverse change clauses are in every M&A deal, and we're being very broad with our language, representing sellers that pandemic closures, COVID, the next COVID, COVID-21. Those are all material adverse changes that are going to be a buyer's issue going forward, a risk to the buyer and not to the seller. So in terms of our deals, I would say that force majeure clauses are extremely important. We did talk a little bit about PPP loans being required to be paid off or otherwise secured. Hopefully that has gone away with the new SBA guidance and the establishment of escrows, the consent of the banks. But the buyers were concerned about successor liability prior to that. And they were still asking for representations and warranties as to compliance because, look, there could be penalties. You can be sure that you're off the hook. We did talk about purchase prices being reduced, and the quid pro quo for that was indeed the earnouts. I've rarely talked about values and what buyers have been willing to offer to sellers against the background of down earnings. And in all cases that I have experienced directly, the gap between what the buyer would have been willing to pay and what the buyer is now willing to pay has been bridged by earnout provisions, and remains to be seen whether or not sellers will be able to meet those earnouts, because we're just continuing to be in a year coming up of great uncertainty, the economic uncertainty that existed apart from COVID, and of course, the COVID risk. So, that's what I'm typically seeing in these deals. Any questions on that or any other topics? I see. Go ahead, Ben.
Yeah, Alan, I think this is great. I think you're hitting all the key points, and folks are really keen in on it. The one thing I always feel obligated to notate when we talk about this stuff is that companies that were strong, weak, struggling, not struggling, this only amplified that situation. I mean, these folks were in situations like this before COVID. So when COVID came along and maybe they were able to make use of the PPP or the SBA discounted stuff, that was helpful, but it's not their solution. So I think this market you're seeing of people looking to get out quickly because they realize they don't want to be in business anymore, and other folks who are out there saying, hey, it's a good opportunity to buy something at maybe a lower price than I could have gotten before. I think it's, it's almost a natural progression of what we thought we'd see. Of course, on the other hand, with those service contracts, it's amazing because I've always seen 90-day notice. You can give me 90-day notice and I can do the same to you, and then that's it, you're done. So you would think that back in March nobody thought it was going to last 90 days, so they didn't enact it, and now suddenly they're going, wait, I'm still on the hook and I got to get my 90 days into play.
Yeah, I think that, look, I think of the deals that were in the pipeline before COVID, most of them, I mean, the buyer had invested in due diligence, and I think those largely continued on. I mean, we lost a couple of deals, but you never know, those could have been, lost anyway. But I mean, still have private equity firms. This has been very much a private equity driven M&A market. And when you think about the private equity firm model, it is still greatly interest rate driven. I mean, these are LBOs. I mean, they don't call them LBOs anymore. I'm not sure what they call them, but they're LBOs. And the ability to borrow money cheaply, maybe just too attractive to pass up. So because when you think about what they're able to pay a seller, again, they're plugging it into a model, and their cost of capital is a significant contributing factor. So strategics are always going to look to pick up businesses for strategic reasons, and I think they're much longer sighted naturally, and so that's going to keep on happening. And private equity, as long as interest rates stay low, and I can't imagine them going up, at least not soon. I think the private equity, which are funds, they got time limits to them. They're no force majeure clauses. They're looking to employ their capital, are going to continue to do so because they can borrow cheaply. You still have motivated sellers, maybe for different reasons now or additional reasons now. But if people want to retire, they didn't not want to retire because of COVID. They want to. If you didn't have a co-shareholder that was a family member that was succeeding to your business, you didn't get one now, right? I mean, the big picture items that motivate sellers to sell their businesses have not changed. The values make it harder. The willingness or desire to not go through this again make it more likely. So what it really comes down to is you got these private equity firms stocked with cash, willing to borrow cheaply. And maybe I'm just the M&A lawyer who just wants to be bullish about all this stuff. But I think that transactions are gonna continue in the future. Now, look, a lot of these companies also, and so again, I'll personalize it because Nixon's a $500 million business ourselves. We have not made the investments that over the course of the last 8 months that we were making before in business development, right? We're in sales, just like, you and your clients, we're all in sales. At some point that's going to come back and hurt you. So these businesses that have been running thin, have been grappling with issues of work from home staff that had difficulty getting work done, it may not have impacted them yet. I mean, people may be buying fewer widgets and you're seeing it in the EBITDA, but the cultural, the institutional core factors that make businesses good businesses, there's been possible erosion there that hasn't been felt because we're still, making believe that we work just as well from home as we work in the office. I'm in the office, so if you get bored, you can look at the LIE behind me. I don't see it because my back is to the window. But I got 2 young kids at home, and they're virtually learning, and it's just not going to happen. Now, my wife doesn't work. I was telling folks on this call before, and this is a full-time job for her, and I'm dealing with like broken printers and microphones that don't work, and running out of paper in ways that make it my job a lot more difficult, because I'm always going to give priority to my family. It's such a widespread feeling across companies across our area, and I think we'd be foolish to think that that is not going to have some continuing negative impacts on business heading into the future. Well, it's about 12:18 now, so I'm just going to open it up in case there are any other questions. I'm happy to answer them.
Christine, I was wondering if you could, add anything to what Allan is saying from the banking side, or any help for some bankers, some people on the call today.
Sure. We were looking at one transaction earlier in the year, and this is it's not a secret. It was actually two public companies, one public company purchasing another public company, and they actually had come to an agreement of terms in January, so pre-COVID. But the company that was being acquired actually made a lot of electronics for the aerospace industry. So, the screens that go in the back of the seats and things. So naturally, since that industry has taken a dive, they try to kind of push along, stretch out the terms of the transaction and try to renegotiate the terms, and it ultimately fell apart. That deal didn't happen. And just from a credit perspective, the banks are just looking at everything very, very closely, and every credit decision that we make, be it for an existing customer, a new customer, every write-up, and it's not just Bank United, it's other banks as well. I've spoken to many friends of mine in the banking industry. Everybody has to include a paragraph on COVID. How does it affect the company? How does it affect the industry? And that is a point of discussion in every credit consideration. I'm looking at a deal now, and it really is not COVID affected. I'm sorry, they do a lot of defense and aerospace work. So the defense industry is really a little bit different than the commercial industry. And that's about, that purchase price from a PE firm is about a 7 times EBITDA, which is not bad. I mean, because pre-COVID, when you looked at a lot of transactions, they were moving up into the 12, 13, 14, sometimes even 15 times EBITDA ranges, which from a bank's perspective was a little crazy. So 7 times isn't bad, but then again, it's more of a cash flow transaction. There's not a lot of assets involved in this particular one, but we're still looking at them. Credit doors are open. They're just scrutinizing everything a little bit more carefully.
Yeah, no, it's
Thanks,
interesting.
Christine.
Yeah, thanks, Christine. I'm seeing a lot of activity in the food and beverage space, insurance, anything in health, life sciences. Is some of you know, Nixon Peabody is a big health firm. Transactional, regulatory too, but we do a lot of transactional work. And I think people have to expect that there's going to be an attraction to companies involved broadly in the health space. And I define that broadly because I think that includes not just healthcare companies, but also life sciences companies, startups that are adept at developing new remedies, therapeutics, but also food and beverage. So because people are eating home more, they're looking at what they're eating more. So I think that we could pretty much guess where the activity is going to be. There's certainly it's not going to drop off a shelf. And I think all people, whether you're involved in a company and looking for opportunities, or whether you provide services to those companies, you're looking to see where the next opportunities are going to be in 2021, and get there before all your competitors.
Allan, one thing, and Christine too, I think one thing worth noting is that, and I find, a couple of the clients that I talk to, that they're concerned about the virus itself because it impacts their business, it impacts their customers and their employees and their vendors and supply chain. But at the same time, what's harder for them to anticipate is what the New York State and what the federal and local governments are going to impose upon them as a response to the change of the virus, right? So, a friend of mine who runs a restaurant, finds out this morning that, parties of 10 have to be limited, and the bars and restaurants close at 10 p.m. I mean, those are things that you couldn't have anticipated in your planning of, even if you stayed as safe as you possibly could. You bought all this PPE, you separated your business, you spaced out your employees at the office, kind of thing. And now these other rules come popping up that you need to include in your plan for expansion, new business, or purchasing another company. So it's interesting that there's so many variables. I think it makes it a little bit more frustrating for people to make decisions. And you might, I've seen it. Like, I worked with a client to put together his return to work program, flow it out and show. And the hardest part was the variance of types of their employees. Some people are, driving. Some people are taking mass transit, and they're dealing with, what do I need to do, to include them and not make them feel separated from the business too. So all of it impacts the business and the flow of service.
Agreed. Okay.
There's one other factor that I didn't hear, but I think it's out there because I have it with one of my clients. They're owned by a PE firm, and the PE firm was in the 5th year. So 2021 was the year to sell as planned, right? And if you go back in 2020 fall, they were pretty much on target. And COVID has done a number on everything to this client's business, my client's business, and that sale isn't going to happen and may even put the PE firm's investment at risk because of what you mentioned earlier. They're very leveraged. So now I'm having as many conversations with the lender as I'm having with the PE firm, and that dance is starting. So it's an interesting place to be that's affecting this market. So maybe you can comment on that if you've seen that too, Allan.
Yeah, well, look, there are a lot of, wonderful businesses that were acquired by PE firms and having nothing to do with COVID. Money was borrowed. There was the economic downturn that people perhaps could have expected, and you just don't have the cash flow to support the loan. And cash cow businesses just don't have that much cash to pay down the debt because some of them just, with a slight downturn in business, they just don't generate sufficient cash flow to pay that. So that's not uncommon at all. I think that lenders and PE firms are in a difficult spot here because, what are they going to do? This is not like this is one problem. It's an institutional problem across all holdings, across all debtors. I think that you really are going to have to place your bets on those companies that you think are going to recover and cut your losses for those that you don't think can. And again, there's going to be a flight to quality, and there's going to be a flight to industries that the assessment is made are less susceptible to downturn if we don't come out of this pandemic or there's some new pandemic.
I have one customer in my portfolio that also is owned by a PE company, only in year 3. So it really, not really ready to sell yet. And they were very dramatically affected by COVID. And we gave them a P&I deferral for 90 days. We gave them a second P&I deferral. And they're trying to get some additional investors in at the current time. And we had some part of the collateral for the transaction. We held a small amount of cash, and we released some of that cash for them to use for 18 months or so for cash flow. And the current investors matched that amount of cash that we released as part of our collateral package. So that helped them out. Now they're trying to get other investors in. And my question to them, and they asked us for a third principal deferral while they do this investor raise, which is, I haven't heard yet at the bank. We'll see how that goes over. I'm sure we'll work with them. But it's a temporary event while they do this investor raise. And my question was, well, what if you can't get any other investors at this point in time to come in and participate in the transaction? What are the current investors willing to do? And they have a plan, and they will put some additional money back in because they're anticipating that by January, February, things will start to open up for them because of who they do business with. I don't want to get into the details, but and they'll be able to collect some more cash, and they'll be able to start generating some more cash flow at that point. So it's, it's very specific with each company. And I think honestly, the banks have been pretty good in working with companies through this pandemic. But it's true, there will come a certain point, God forbid, should this thing linger on and continue for another year, what's going to be the breaking point? Who's going to, at some point, you can't keep deferring principal and interest forever. You have to make some sort of payment schedule. And how long do you just be patient and wait? And we all know it's going to come to an end at some point, but how long do you do that? Because of course, then you've got regulators on one side saying, well, how long are you going to defer? When does this become a non-accruing loan? When does it become a problem? So we really are trying to work with customers. And I have to say, we're just taking each case individually and dealing with each one as it comes.
Yeah, it's all we can really do. Right? Like every day that goes by, I say to myself that I'm now a day closer to a vaccine, right? And you just need the days to pass. But we're in for a very bad stretch, I think, over the next few months. I think that there's no doubt about that because this COVID's like pretty deeply seated. I talking to my wife this morning. I'm like shocked if at some point our office doesn't close down again. And maybe I'm wrong, but I mean, I'm just reading the numbers and seeing what's kind of happening out in the world. So again, I think it returns to flight to quality. I think that the quality businesses are going to make it through. The businesses that are hangers on just are going to have a lot of trouble hanging on over the course of the next few months. They'll have difficulty recovering. So whether you're a buyer, a seller, be involved with a PE firm, anybody, I think that you really need to focus on the highest quality companies and the correct industries, and there's probably a lot of overlap there.
Thank you, Allan.
On a good note, I just wanted to close with, on a good note, this morning I heard on a couple of news channels that they're talking about what numbers of people who go into the hospital, how quickly they're treated and released, which is a good sign because it makes it, I guess, a little bit more normal to regular diseases as opposed to this mystery of, you have 7,000 cases and you have no idea what happened to them. So I think that's a positive thing for people's feeling of, hey, there's an end to this, or there's a treatment for this, which wasn't the case, for the last 8 months or so.
Well, we're lucky to live in New York area, that's for sure. I mean, this is all Northwell's been thinking about since June, is this fall. I speak to them all the time because I do business with them, but they've been focused entirely on what is happening in this area now, and they're ready. I'm sorry, Nick.
And to add to that, Dr. Fauci, who tends to be very conservative, he's been talking a little bit more positively over the last week or so. So, I think it's on the horizon, but to everybody's point, we likely still have another tough 6 months, even with a fast deployment of the vaccine. I mean, 330 million people times 2, because it's just a really monumental task that they're dealing with. So we'll keep our fingers crossed, but at least it seems like there's some good news on the horizon.
Great. Again, we're getting close to our time. Allan, thank you very much. I see many people added their contact information into the chat room. We will send around a attendee list so everyone could catch up with people and introduce themselves more formally. Anything else?
Nice
Great.
presentation. Thank you, Alan. And thanks,
My
everybody.
pleasure. Thank you for listening.
Good seeing everybody too.
Thank you.
Kelly, do we have anything else we have to say, Kelly? Okay. All right, everyone. Great. And be safe.
Nice
Bye-bye.
meeting everyone.
You will,
Take care.
everybody.
Bye-bye now.
Bye.